Good evening, everyone, and welcome to the Brian Crombie Radio Hour on Sauga 960. You know, I think topic number one in most households around the GTA today is housing prices. Interest rates are up, going up. Some people think going up even further. Potential of a recession because of it coming up. Inflation is at a 30-year high. And the impact of these increased interest rates has slowed down the real estate market fairly dramatically. Some people think has impacted prices. And so therefore, I thought I'd check in with two people that know what they're talking about in regards to the real estate market. And so tonight, I want to introduce you to Serena Holmes. She is the former CEO of a multi-award-winning brand experience agency turned licensed realtor with Harvey Kells. She has been an active real estate investor for over 10 years with a large focus on private lending and recently published the book, The Accidental Entrepreneur, at the end of 2021. Accidental Entrepreneur sounds interesting. We'll have to ask her a little bit about that. Joining her as our guest tonight is Dylan Suitor. He is the founder and rainmaker of Elevation Realty Network, number 7 for sales volume in Keller Williams Canada, focusing heavily on investors and apartment buildings. Co-founder and partner in Keller Williams Legacies out of Vaughan and owner of Keller Williams Co-Elevation in Bloor West, Toronto. Dylan is an active real estate investor with over 1,000 doors with his handful of JV partners and is always focusing on highest and best use for his investors. Dylan believes that he's always puts his clients' investors first, but won't let a good deal be passed up. He's actively buying on the dip and has a positive long-term outlook on the real estate market in Ontario. We're going to be talking to Serena and Dylan tonight about the impact of the mortgage rate impacts, what they're having on the real estate market, and what this means for buyers and sellers and renters. Serena and Dylan, welcome to the show tonight. How are you both doing?
Thank you. Great. How are you?
Good. So we're going to go through some statistics in a couple of minutes, and we're going to actually talk about quantitatively what's actually happened with mortgage rates and sales and volume and things like that. But let's just start from an overview standpoint. Serena, tell me, Dylan says he buys on a dip. Are we on a dip, or are we on a crash, or are we on a level playing field?
Yeah, so that's obviously his comment, so he can speak to buying on the dip. I do understand the context.
That's why I'm asking you.
One that's buying up the market. So
I want to know what you think.
You want to know what I think? Okay. Well, I think just because prices are going down for me personally as an investor, I've been waiting a little bit to see where the prices go, because if I can buy a home or a multifamily property for 30% less than I could have 6 months ago, then to me, it makes sense to hold on it and wait to buy when the dip is a little bit lower than it currently is. I think some people think still go ahead and buy now. I think that the rates and the prices may still be comparable. But for me personally, as an investor, I'm choosing to wait, and I've parked a bunch of money in private lending to wait where things go down further.
So do you really think things are down 30%?
Yeah, they are. I mean, statistically, prices are sitting now where they were last October. So they peaked at the beginning of the new year with kind of record sales coming out of 2021. We had about 122,000 sales for 2021. The last record was in 2016 with 112,000 sales. So we definitely hit a big peak kind of coming out of the end of last year. And then now things are starting to normalize to where they were last fall.
But if they're only back to where they were October, back last spring and summer, I was hearing about 20-40% increases over prior year then. So in reality, we're still, some people would think, in bubble territory. Are we not?
I think we could potentially be. I mean, it's my personal opinion that we're going to continue to see the decrease as the mortgage rates continue to rise. But maybe, Dylan, you can elaborate on that yourself as well.
Okay, Dylan, she keeps on throwing it over to you. So what do you think, Dylan? Is this a dip? Is it the start of a crash? Or is it going to level out?
We've seen a very stark price correction in most cities in Ontario, Southern Ontario, especially over the since February, at least last 4, 5, 6 months. Some areas have seen a sharper correction than others. Toronto's actually held strong for the most part. And I think a lot of that has to do with people leaving during COVID and coming back to Toronto, being able to buy and be able to afford. However, I like to think from an institutional level. We have BlackRock coming into Canada, looking at buying up billions of dollars in real estate. 15% of transactions in 2021 went to institutional buyers. What's ultimately happening is we're moving more to a renter's economy, in my opinion. And so I like to think institutionally. If I can buy a home that would have been $250,000 last year, and yes, I'm using a really low number because I buy a lot up north. But if you looked at a price per door and you looked at an apartment building in Hamilton and you could buy at 200, 250, 300,000 per door, and you could rent that for 1%, of what you paid for it per month. So let's say you can buy for $250 and rent for $2,500. Well, if that property just fell by 30% and we're into that 170, 180 range, rent's still $2,500. I am then cash flowing even more. And if my interest rate goes up short term, my belief is long-term interest rates will not stay high. They will go high to combat inflation. That's what the government gets to do. They get to play with that a little bit. However, they still have that cost of borrowing as well. So my long-term outlook is that we're likely going to see interest rates hover somewhere between 3 and 4%. And then if we see 5, 6, 7, 8%, a lot of what they're doing and increasing them to the Bank of Canada is to slow spending. Inflation's based on consumer spending. And right now, people saved up for 2.5 years, sitting on the sidelines through COVID, not being able to spend the way they normally would. There's a lot of pent-up demand and a lot of pent-up savings that are actually getting wiped away right now through inflation and through the interest rate changes. So for me, when I look at something, it was a phrase that I heard when I first entered into real estate. Sometimes you buy a property and you think that you're overpaying today, but in 5 years you look like a rock star. And I want to look back 5 years from now and look at the opportunity that I had to buy and continue to buy positive cash flowing assets that provide increased opportunity and appreciation long term, but it's the cash flow that I buy on. And there's no amount of dip that's going to stop me from buying, because we have 500,000 or so people coming to Canada every year. And right now we have a supply issue. The biggest piece that I'd love to focus today on, and you'll lead the show, but I think it all comes down to supply and demand. And right now we do not have enough housing. There was just over 200,000 houses completed last year and almost 500,000 people that came to Canada. And we've had a housing shortage, especially in Ontario and BC, which really comes down to Toronto and Vancouver. So until people start spreading out and moving in northern Saskatchewan, I don't foresee that our Southern Ontario supply issues to be corrected anytime soon.
Okay, I agree with you that supply is a big issue. There's just no question about that. And I've done shows on the lack of supply. The CMHC, as you probably know, thinks that we need 1.8 million additional homes in Southern Ontario in the next 8 years if we're going to have housing affordability, and not additional from where we are, but additional from what they think would otherwise be built normally. So it's an astronomical amount, and it's based on this 430,000 immigrants a year that the Trudeau government, the Liberal government, has said that we're going to be accepting, and about 40 to 50% of them end up coming to Toronto. So the statistics are that there's a city of Montreal, effectively 1.5 to 2 million people moving to Toronto in the next 10 to 15 years. So it's an astronomical amount of people. So unquestionably, supply is an issue. But let me challenge you, if I could. The debt to incomes and the house prices to rentals in Canada today are where they were in the United States in 2008, prior to the subprime crisis and the crash in the United States. And that crash took, 30, 40% out of house prices. And some of that is still there, other than in the coasts in New York and San Francisco. Some house prices in the United States still haven't recovered. So, and it took, that's like 12, 14 years ago. So given that, and we've seen articles, you've undoubtedly seen articles, comparable homes in suburban New York, not Manhattan, but suburban New York to suburban Toronto. Toronto is 3 to 4 times more expensive for the same income level. So how is that not set for a crash, a bubble burst, a complete disaster for Canadians?
You know what? There's no crystal ball to say that isn't going to happen. However, I personally don't believe it is, and I would rather accumulate those assets, especially if they're going to be positive cash flow, because even those people that did feel that crash 14, 15 years ago, if they still had positive cash flow and rental rates continue to climb, which they continue to do, people can't afford to buy, they end up renting. Unless they're going to leave completely, those cash flows remain, and therefore the carry costs are covered. And as long as the carry costs are covered, you can weather the storm. You also did comment on some of those areas in the U.S. that are still feeling that. If you look at Florida, or you went to Florida anytime of recent, you'll notice that those prices have gone absolutely through the roof. And so I think that when we look at Toronto, when we look at Southern Ontario, it is an extremely desirable location in a country that has a lot of opportunity to grow population-wise and a lot of government restrictions on development and build and the ability to actually create more housing. CMHC from a financing structure as well, they're doing up to 95% loan to value on apartment buildings right now. And the only reason they're doing that is to try and increase affordability, which I actually really do appreciate that mortgage type and that support from CMHC in the multifamily space. And I'm happy to dive a little deeper into that as well. But I think that the build is very, very challenging to do. We had 12,000 new builds canceled as soon as the Ontario government increased the development charges in Toronto by 50%. And that ultimately is 12,000 new homes that people won't be able to get into. The cost of building is going up. Like there's a lot of economic drivers that, quite frankly, if they continue to go, maybe we do see that correction. I don't know what the long-term solution is for that correction, but at the end of the day, if I can have a cash flowing property that continues to wait out the storm, as an investor, I'm going to do that.
We're chatting tonight with Serena Holmes and Dylan Suitor about the real estate market in the Greater Toronto Area. We're going to take a break for some messages and come back more with Serena and Dylan in just 2 minutes. Stay with us, everybody. Welcome back, everyone, to the Brian Crombie Radio Hour on Sauga 960. We're having a spirited discussion / argument tonight about the real estate market and whether it's a dip that you should buy on, whether it is just resetting to where we were last October, or whether it's a crash in the offing. And my guest tonight are Serena Holmes. She is the former CEO of a multi-award-winning brand experience agency turned licensed realtor, with Harvey Calls, and also Dylan Suitor. He is the founder and rainmaker of Elevation Realty Network, number 7 for sales volume in the Keller Williams Canada organization, focusing heavily on investors and apartment buildings. Dylan, he said institutions were coming into Canada big, and we're buying up residential homes to rent out. You mentioned BlackRock, but you also talked about something like 13,000 homes or condos being put on hold. There was an article, I think just today, that said 10,000 condos were being put on hold. Didn't mention development fees, though development fees going up 47% clearly is an issue, but talked about concern about pricing and housing prices. I get emails on a, if not a hourly basis, maybe every 2 hours about new price reduction and deposits on new condominiums that have gone from like 20% to 5%. Big deals at 5% deposits down. What's going on?
That's a great question. I mean, what we've seen was we had supply chain issues. Through COVID, the economy shut down, essentially the world shut down, and those supply chain issues are catching up to us. If you're a 2x4 manufacturer and you can only produce X number of 2x4s and the demand is 10X those 2x4s, you increase the price of 2x4s. Anybody who's walked in the grocery store and has bought a loaf of bread or dinner off the shelves at any point in time have seen the impacts of inflation. And that really comes down to supply chain issues that I think are the bigger problem and the root cause of this whole thing, with prices going through the roof. When you see prices of materials go up, builders have to increase their prices. When builders increase their prices, investors need to have a higher rent. When rents continue to go up, prices continue to go up. And when interest rates are at an all-time low and unemployment's at an all-time low, it creates this big bubble of problems that we've now had. I do think that there are some things that are starting to come back in alignment a little bit. I mean, wood prices are down from what their peak was.
50%
We're seeing interest
down.
Yeah, they're definitely down, but they're definitely not where they were prior to the COVID lockdowns.
No. Serena, you've got buyers undoubtedly that have bought in the last 6 months. And what you've said is that we're back to October prices and we're 30% down. People typically put what? 20, 30% down as a down payment. And so therefore, they've lost all their equity. What is that?
I think that's possible. I think because of the prices escalating so much, 20% is what, you should technically be putting down. But I think because of the prices increasing so much, I had some buyers that were definitely putting down less than 20%. And I think the concern for them is that now they're in this home that's not worth what it was. And then they're being hit with the higher interest rates, potentially, if they didn't lock in a fee as well. So I think they could be concerned, but I think it's, real estate is a long-term gain. Like, you don't necessarily move into a house just to live in it for a year or two. So if they live there for the next 10 years, yes, it may go down in value for a short period of time. But like Dylan said earlier, if you wait 5 years or 10 years, it's going to escalate that much more over the long term. So I think
someone that's bought in the last 6 months that's looking at negative equity in their home today, you don't think they're going to be worried? You don't think they're going to sell and just give back the keys? And
I think they would be silly to sell. They're
going to wait around.
They're going to lose money across the board if they do that. I think you just have to keep your eye on the big picture and know that you just have to wait it out, whether that takes another 2 to 3 years. Like I said, unless you're maybe an investor that was planning to buy something and sell it during a shorter period of time, or life happens and you have no choice but to sell, there could be times when you lose your shirt because you have no choice but to sell low when you've bought high. But I think for someone buying a home that plans to stay there a while, then I think they'll be fine.
Okay. What about people that are closing today on house purchases that they made sort of before the big rate increases? And are the banks still honoring old appraisals and the mortgage commitments that they made a couple months ago?
Yeah, I think it really depends on the timing of some of those situations. I think the bank appraisals are definitely a concern. I was involved in some of the different offer presentations. And one of the things that we did to feel out the buyers was that if, for example, a townhouse was only worth $900,000, they put in an offer for $999,000. Could they make up that difference of $100,000 if the appraisal fell short? So that was part of our due diligence, just to make sure that there weren't issues with closing or the deal falling apart or something like that, where we actually even asked the buyer's realtor to show proof that they can make up that difference if the appraisal didn't come in as high as it was. And again, this is going back to like January, February, but that was definitely a concern for us in some of those high multiple offer situations where homes were going, $200,000, $300,000, $400,000, $500,000 over list price.
Now, what happened in the United States in the fall of 2008 and going into 2009 is different in Canada because there they have non-recourse loans, such that if you actually have negative equity, you can actually just give back the keys and walk away. And you no longer have that debt. In Canada, we have recourse mortgages such that you can't walk away from that debt. It follows you, even if you give back the keys or try to give back the keys. So it's a lot more difficult to get out of that debt position, even if it's underwater.
I think
tell me how that plays out.
Creative ways to make it work, whether it's something that you're living in, or maybe you rent it, or maybe you reconstruct it where you can rent on separate levels of the property or something like that. I think it's in your best interest to hold on to it, so you're not followed by debt if you decide that that's not working for you.
It's interesting. I think from a regulatory standpoint, we actually have a system in Canada that harms consumers and benefits the banks and gives protection to the banks, because we don't allow non-recourse financing of mortgages versus the United States, where consumers can walk away and the bank's got to take the hit. And then you got the banks. But what it ends up doing,
I don't think that's good either, though.
Well, what it does is it slows down in Canada a market depreciation versus the United States. What it does is it accelerates a market depreciation because you end up having a lot of people giving back the keys, and then the banks turn around and want to sell a whole bunch of homes real quick. So it sort of takes longer for a negative impact to be felt in Canada. Were either of you around in 1990 and 91, 92 when the last big house price decline took place?
I mean,
I was just born.
I was 10 years old, so I was around. I probably wasn't paying close attention.
So you've probably got some peers that have told you about that. It took, a good 5-7 years for prices to get back. And the vast majority of bankers, analysts, mortgage brokers, real estate agents, real estate brokers said this had never happened. Wasn't going to happen. There was one analyst on Bay Street that called for it, said it was a bubble, and it ultimately happened. 20-30% price declines, and not from a huge, quick over extended level like you've described, Serena, from last October, but from a long-term basis. And it took like 5-7 years to recover. Do any of your peers think it's going to be like this, or are they feeling like Dylan, it's going to come back pretty quick?
I haven't seen it says that they think it's going to be long-term. With my brokerage, when we have our meetings, our CEO often talks about, what's happening now is more comparative to maybe 2017 or something like that in terms of prices. So it's important just to follow.
Which came back fairly quick, did it not?
Yeah, that's what he kind of thinks. And I think just the general consensus is that COVID kind of created this unique situation that inventory was low, demand was high. Suddenly people could kind of move around. They weren't necessarily stuck where they were based on where they were working and things like that. And it just created this very unique situation. So yes, things climbed, but I think they're just trying to bring things now back to where they were before. And I think for that reason, a lot of people don't necessarily think this is something that's going to last for, the next decade.
Now, Dylan, you say that you've got businesses in Bloor West Village as well as Vaughan. And so let me ask you about, one of the things that happened during COVID is people could didn't have to commute to downtown Toronto as much. And so therefore 905, 519, 705 even accelerated to a great degree, even more so than what was happening in Toronto. Now, when people are starting to come back and a lot of companies are demanding hybrid, if not full-time, showing up again at work, what's happening? Do you have a bigger depreciation outside of Toronto versus what's happening in Toronto?
Serena can probably talk to Durham region as the area that actually fell the hardest and the fastest. And they were the first one where you saw reports out where the peak in February, right when Ukraine and Russia started off, was that week. I remember calling and seeing that there were people that were selling townhouses across the street for 2 weeks. 2 weeks later for $300,000 less, $1.2 million down to $900,000 overnight. And that was a consistent theme in Durham. When you look at some of the reports on what you see from the falls, Durham had the hardest hit. There are some cities, I mean, I know Burlington, for instance, was a city that's held strong, but the city that's held the strongest has been Toronto. With those brokerages, with the conversations I'm having, I'm personally in the West End. Like I'm out Burlington, Hamilton way. We felt the hit in February, March. We're starting to see things kind of even out a little bit, and that interest rate hit is not hitting us as much. Toronto, I'm just having the conversations over the last 30 days. And the economic drivers are showing that it's still going to hit and it's going to have that problem and that problem to people, that issue people. But I think there's a couple other things we need to go back to on the conversations you guys have had. I mean, you mentioned 2017. In April of 2017, that was what we call the peak. And so April 2017, it took up until September 2019 to actually see a higher valuation across all of Ontario. So when you look at the average price points across all that area, it took a year and a half to actually get back to those numbers. I think that it's going to be longer to get back to those January, February prices. But January and February, we saw like a 10, 15% a month increase over December prices or over November prices. The market went absolutely insane. And I think that bump in January and February, those people could potentially be in for problems. But majority of our variable payments are actually not variable payments. They're fixed payments on a variable rate mortgage, which is really important to understand, because most of the time you think it's a variable rate mortgage and interest rates go up variably, then your mortgage payments are going to go up, which isn't entirely true. What you'll find is there will be some people that will be paying nearly 100% of their mortgage payments will go directly to interest, and they won't be paying down the principal because of the increased interest rates. A very small portion of our borrowers are actually in a variable payment, variable rate mortgage, which would actually change the mortgage payment. And most of these are 5-year commitments on these variable mortgages. So you can have 5 more years of people paying fixed variable rates. And if it takes 2 or 3 years for us to get back to the same price, they may not have to actually bat an eye, because they're not going to have banks coming in and taking those properties. We also have to keep in mind, we have the stress test. I mean, they implemented the stress test a few years ago. You have to qualify at 2% higher or the benchmark rate, whichever is higher. And people were qualifying when interest rates were down at 1.5% or 2% at 5%. That's important to follow, because if we have to qualify at that amount, there's a lot that interest rates can go up before people start losing their houses. So I think there's a number of different factors that need to be taken into consideration. And this would really have to be something that we saw 3, 4, 5 years of houses underwater before people would actually be underwater in a must sale or a must sell and lose their house perspective.
So let me challenge you on that again. I apologize, but that's my job as a radio interviewer. I've got to try to challenge you. I was down in Florida actually last week. You talked about Florida. I was actually out in New York, in the resort area of New York. In both places, people were talking about how a bubble burst was coming. New York Times did a 4-page spread 2 weeks ago on how housing prices in the United States, in New York, suburban New York, resort New York, et cetera, was set for a bubble. And the reason why wasn't the reasons that we've had in Canada, but lack of supply because of government regulation, or because we didn't end up having in the United States the impact of 2008, 2009, because they had that. It's just because of asset prices, because of low interest rates, and that the interest rates were so low that people were buying up assets, and they bought up the stock market. The tech market is down 35%. The regular market is down 20%. Venture capital and private equity is down 50%. Some VC assets are down 90%. SPACs are down. So anything that was available in the marketplace that was attractive and bid up because of, historically half a century low interest rates has come down. And so the question is, why isn't it real estate? And so I guess I wonder why it isn't more profound than what you're describing, Dylan. What you describe is maybe a year and a half to get back. But you don't think it's a massive crash that's going to last for 7 years.
I'm not going to say that it's a year and a half to get back from the peaks. And I actually had conversations with my financial advising team at Scotiabank last week, 2 weeks ago, that are writing articles. And they were talking about back in the 90s, early 90s, when this stuff happened. It took 7 or 8 years to get back to that. I wouldn't be surprised if we're 5 to 7 years to get back to the same prices in certain cities that we saw in January and February. There are numbers, there are sale prices that will likely be that high for a long time. However, if you are someone that bought a home in 2020, you still have equity in that home. We haven't hit nearly that kind of crash. And I really don't believe that we're going to see another 5 or 10% decrease in house prices for each month for the next 12 months. And we would really need to see that to get back to our 2019 or 2020 prices. So there are certainly people that are definitely in trouble that bought in January or February. And when I say in trouble, it goes back to those payments. If someone has a fixed payment and they locked in at 2% back at that point in time, what do they really care? They may not be able to move, but I think what we really need to do is start thinking differently. Those interest rates that we had for a decade at stupid low rates, the reason that people were buying those up is because they saw that they could make money, because realistically, if you could borrow at 2% and you had asset prices going up by 10%, you were making 8% on the bank's money. And where we're at now is people have to think differently about that. And there's probably people that were buying because they thought, hey, I'll just move every 2 or 3 years. People used to move every 7 years. People are now moving every 2 to 3 years up until this most recent correction. If people had to stay in their homes for 5 or 7 years to actually have equity that they could buy and they could move to another home, they'd have to make a decision between staying in their home or lose $200,000, $300,000, $400,000 now. And the market that they sell in, losing $200,000, $300,000, $400,000, $500,000, they'd have to then determine, do I want to become a renter or do I want to buy? And if I'm buying, I'm just allocating that loss of $200,000, $300,000, $400,000 to another asset that hopefully is down $200,000, $300,000, $400,000, $500,000. But it really comes down to a mindset. It really comes down to the way that people are thinking about things. And we can't be stuck in this idea that every time I buy an asset, I'm going to be able to add a little bit of value to it, or I'm going to be able to sell it again in 6 months without touching it and make $100,000, which is really the mindset that we were in the real estate market.
Yeah, Serena, I think it is a lot psychological, isn't it? If you think that real estate's going to go up forever and never going to come down, you're willing to buy and pay a lot more and bid higher than the asking on a lot of the assets that are out there. But if you think that real estate could go down as easily as it could go up, and it could go down by 10 or 20 or 30% as easily as it could go up by 10 or 20%, you become a lot more judicious in your asset buying, and you buy something that you really can afford and something you really want to live in, rather than something you just want to speculate on. Yeah. Don't you?
I think that one of the biggest words that I've heard pertaining to this situation is that it wasn't sustainable. So, for example, if you look at what the housing prices were like 15 years ago and what the salaries were like to where they are now and what the salaries are like, it's not like salaries have grown up by multiplied 10 times, right? So a townhouse was worth 200,000 is now worth $1 million. Well, if you're making 50,000 a year, you're not now making 400,000. So I think when you look at that, we're in this really weird position where the prices have escalated so much, but then there's the supply issue. So it's like this compound thing that I think it's just created a lot of issues. I don't know what the solution is. Like, we have a lot of environmental regulations around building in the golden horseshoe. So I think that there's some limitations to how much more we can continue to grow. I think they're trying to push redevelopment of different places. So maybe, apartments that could accommodate 12 people now could accommodate 24 units or something like that. But I think we just have to think more creatively where how development is going to continue within the city, because you just can't continue to sprawl out unless they start going into protected areas and areas that they don't want to touch.
Well, the Doug Ford Conservative government got reelected. One of the main planks they had was Highway 413. There's a lot of developers that have got a lot of land around 413, and they want to make it look a lot like 407, which is like nonstop development on both the north and south side. There's plans to take Caledon from 50,000 to 500,000 people. Stouffville is one of the fastest growing cities in all of the Greater Toronto Area, as it grows unbelievably. When I moved into Markham, eons and eons and eons ago, it was like 10 or 15,000 people. Markham now is a major city.
Yeah, I lived in Stouffville when I was younger as well. So now seeing like that same drive up to my dad's, it's just crazy that it was always farmland or even a little bit industrial. And now there's like suburbs going everywhere and estate properties and things like that. So
there's 16-story condominiums in Stouffville. Whoever dreamt that there would be 16-story condominiums in Stouffville?
But that's the thing. There's only so much land, right? So it's kind of, we're in this weird spot between the economics of it and then the supply and demand of it.
We're chatting tonight with Dylan Suitor and Serena Holmes about the real estate market and what's going on. And Dylan is of the belief, I'm going to paraphrase, he's going to disagree with me vehemently with my paraphrase of him, but he says this is a dip. Don't worry. We'll all be back and fine in a year and a half. Serena is saying, you know what, you've lost what you've lost since October, but we're just back to where we were in October. And so both of them, I think, are trying to give everyone some confidence, and probably justifiably so, because what they're saying is, particularly if you're a long-term homeowner, not necessarily an investor, but homeowner, and you're going to live in the home that you bought, don't worry, because 5 years from now, 7 years from now, when you might want to move and sell, probably real estate pricing has come back to where it has been and they think should be, based on limited supply, controls on land, that you can't build south of Lake Ontario, that we've got a green belt, and that people, some percentage of 430,000 people that the Liberal government are allowing as immigrants to come to this country, as well as people from the rest of the country that want to come to Toronto. Long term, it's going to mean there's going to be demand for homes. I'm worried that it's going to be a lot worse than that. Anyway, that's what makes that's what makes a market, and that's what makes it for an interesting discussion. We're going to take a break and come back in just 2 minutes with Serena and Dylan. Stay with us, everybody.
Okay.
Welcome back, everyone, to the Brian Crombie Radio Hour on Sauga 960. I'm chatting tonight with Serena Holmes. She is the former CEO of a multi-award-winning brand experience agency turned licensed realtor with Harvey Kells. She's been an active real estate investor for over 10 years, and she's got a large focus on private lending, and recently published the book, The Accidental Entrepreneur, at the end of 2021. We've also got Dylan Suitor. He is the founder and rainmaker of Elevation Realty Network. He's number 7 for sales volume in Keller Williams Canada, and he focuses on both investors and apartment buildings, as well as homes, focusing in Bloor West and Vaughan. Dylan and Serena, thanks so much for joining. I really appreciate your comments. Serena, you wanted to take us through some statistics that really describe where we are in the marketplace today. Tell us a little bit about what you think is happening with interest rates and pricing.
Yeah, sure. I'll actually share a visual here just from a mortgage broker's presentation that I had not long ago. And basically what they're sharing, I'm just going to make sure I'm sharing properly here. Can you guys see it okay?
Yep.
So basically they're talking about if you were to buy at the peak of the market that was, maybe $980,000 with an interest rate of 2%, your monthly payment might look like $28.95. Obviously, this is subjective to your down payment. And right now there's the concern, well, should I buy? Are rates going up? Well, if you buy that same property for $800,000 instead of $980,000, the rates are 3.5% or potentially more, then your monthly payment's only going to be $28.64. So it's literally a difference of $30 a month. Again, this is subjective depending on what you're buying for and what the rates are like. But I think there's a lot of hesitation that rates are going up. But they're kind of where they were. When I bought my first home 15 years ago, my rate was almost 6%. So, you still went ahead, you still bought. It doesn't mean that rates are necessarily going to stay that way. But I think it's just a matter of how long you're necessarily in that property that's going to matter. And just really numbers. I think that's the most important thing.
Okay. So what you're effectively saying is that because prices have declined, currently higher interest rates on a lower price may end up being the same mortgage rate.
Exactly. So you just really have to look at your numbers. I think don't be afraid of the media. I think there's a lot of, yes, it's reality, what's out there, but it just felt like the buyers disappeared overnight. Like we went from seeing 20 to 30 offers in a multiple offer situation. Like that was the norm on presentation night to literally like a home may not sell on offer night. It may sit now for 2 months. But people still need to buy, like people still need homes. They're going to be spending a lot more money on rent. And if anything, some leased properties are actually going into multiple offers now. So it's kind of a weird thing. But if you have the money saved up, I think it's smart just to talk to your mortgage broker or your bank know your numbers, and the numbers might not be as scary as they might sound when you just hear about the rates going up and up and up.
Okay, so you wanted to tell us about rates going up and up. What are the numbers that interest rates coming down and going up? You had a graph on that as well.
Let's see here. So we've got one here that Dylan can speak to. This is his graphic here, but the effective interest rates on mortgage payments. I'm just going to share my screen. Sorry, there you go. So Dylan, if you want to speak to this, it's just talking a little more about the effective interest rates on mortgage payments.
This is very similar. And realistically, what we would look at is on the far left side, you'll see a 2% interest rate at the top, and you'll see $1 million on the left-hand side. And if there's 0% change in that property, the mortgage each month was $3,720.83 based on the numbers that we used at this time and a 30-year amortization. If you follow that graph over to a 5% interest rate, and you go all the way to that $5,400 a month for that mortgage payment at $1 million, but then you go up to find the closest payment at $3,720, what you'll find is that price will end up being at $650,000 $700,000. And that's a 30% decrease in the home price. So with a mortgage rate that would have cost $3,700 a month on that property, that same property for $1 million is down to $700,000. And we've actually seen about a 30% fall as interest rates have gone from 2% to 5%, which shows that the affordability is really dictating what home prices are in the buyer's market. So it's very similar to what Serena just mentioned, is that you see a 30% decrease in home prices. Your mortgage payment ultimately is the same if you're at a 5% now versus a 2% before. Now, there's a lot of talk about a recession and what the recession may be. I mean, the economic definition of a recession is 2 negative quarters of GDP growth in a row. We saw that Q1, we saw that Q2. Technically, we're in a recession. No announcement's been made, no conversation's been made other than a statement from the White House in the US not long ago talking about a definition change. And what happens in a recession? The government has to try and increase spending, but we already have inflation rates as high as they are. We already have spending going through the roof. So realistically, if when they declare a recession at some point in time, they're going to have to somehow stimulate the economy to get things going again, whether that be from bringing interest rates back down or that be by helping with printing more money, creating more money flow, which ultimately just causes the exact same cycle with inflation. So what's the overall solution of this? I look at it and go, you know what? Maybe it's a year, maybe it's 2 years, maybe it's 5 years. But if the interest rates that I'm at right now, and I'm buying in a variable with fixed payments, as I mentioned to you a minute ago, and I commit to what a rate may be 5%. Right now, your variables are lower than that. But if I get to a variable at 5%, it's prime minus a point or prime minus half a point, whatever that may be, realistically, as rates do go back down, if they do, I do think they'll go up a little bit more for the rest of this year, but I do think they'll find their way back down. And when they do, if I was buying at something that it's a 5% and I'm buying at a 30% discount, and that rate ultimately cost me 4%, and it's only a 20% discount off the high, which is actually a $100,000 increase on that same $1 million home when rates do go back down. If it doesn't, what it will end up doing is increasing my cash flow, or if I have fixed payments, it'll increase the amount of principal that I pay down, which ultimately creates more equity in my home long term.
Dylan, you know, it's interesting. The graph that you just showed suggests that the housing prices go down by the exact same percentage that the mortgage rates go up by. Not by, absolute. And people think about, 2% going to 3%. That's not a big change, but it's a 50% change. And what you've shown is that the housing prices went down by 30% when mortgage payments went up by 30%, direct correlation. We had a 100 basis point increase in Canada. The United States went up by a comparable amount. Just last week, people were talking about comparable amounts coming up in the next month or two. We have right now the highest difference between inflation and interest rates than we've ever had. So either inflation's got to come down, or interest rates can't go up by just 100 or 200 basis points. They've got to go up by more. And, you, I think, have done a good job of talking about why inflation is so high. Supply chain issues, clearly they're there. The war in Ukraine clearly is a problem. The impact of COVID. But is any of that going away? We've now got another variant, and supposedly COVID infections are at an all-time high. They're just not being reported. The war in Ukraine sounds like it lasts quite a lot longer, and people are talking about being a situation that we're stuck in for a long period of time. And supply chain Beijing is looking at more controls. There's still a whole bunch of tankers, ships, etc., sitting outside of Shanghai Harbor, not bringing goods across. I tried to buy an HVAC system last week, and it was a 3-month delay if we could get it. I talked to a contractor that was ordering windows and cabinets that needed to arrive in a year, and they were pre-ordering them already because they wanted to make sure that they would actually arrive. So if you were of the belief that inflation is not going to come down anytime soon because of these reasons, and therefore interest rates had to continue to either go up and or stay high, what does that mean to you?
Ultimately, what it comes down to, the simplest way to look at it, is that if interest rates are today at 5% and you're still going on vacation and you're still buying nice things and you're still increasing your lifestyle and you're still spending, as a collective in our country's economy, inflation will remain high, which means that interest rates need to continue to climb. If all of a sudden interest rates go up by 100 basis points and now we're at 6% interest rates, and you still buy, and you upgrade your car, and you upgrade your home, and you take the family on nice vacations, you buy all these nice things, and interest rates go up again to 7% and 8% and 9%, interest rates will continue to go up until, as a country, our spending calms down a bit. And we have a lot of pent-up savings, but that savings will get eaten up quickly, is my opinion and my belief. And I do think that we're going to cap out. I wish that the government would have increased interest rates earlier and faster. When we were getting a quarter point or a half a point, when we were in that 0.5%, when we were at the beginning of the year, they should have done the 1%. I'm glad they did the 1%. They kind of had to do that 1% because they need to catch up. As we're seeing that the prices are affecting us, as we're seeing these concerns of recession, consumer confidence is at an all-time low. And until they get that in control, I don't expect that inflation is going to completely come down. What we have seen is that inflation isn't continuing to go up at the same level that it has. So what they've done has allowed to bring things a little bit more in the norm, but inflation does need to go down, or we have to be okay with a 5% average inflation rate, which is the biggest risk to democracy that the government possibly has. The only control they have is keeping a 2 to 3% inflation rate annually. And quite frankly, housing prices going 20, 30, 40% up a year was never sustainable. And it's not a good thing for anybody other than a couple of people that have houses. But long term, that's not the solution. So if we can find a way where interest rates are in that 3, 4, 5%, and inflation is in between 2 and 3% each year, and housing prices continue to go up at those rates, 3, 4, 5% a year, that would be a really big win all around. And I think the biggest issue for all that is going to be supply. I did mention it earlier today. CMHC released the Mli Select Program when it comes to financing of multifamily properties. That program is one that is really helping long-term outlook on affordable units. One of the biggest ways that you can qualify for up to 95% loan to value and a 50-year amortization on a multifamily home is if you're actually going to guarantee the current rent that you have in that unit is below a certain number based on average renter's income in the city, and that you're going to guarantee that rent for 10 years. That doesn't mean that if that person leaves, you can increase the rent. That means if you're currently paying $800 a month in Hamilton, and that unit is tagged for that CMHC financing, and that owner goes and gets 95% loan to value on a 50-year amortization, they are guaranteeing that that rent will still be available at that exact same price, no matter how many times it turns over for the next 10 years. And what I think will happen is that a lot of these renters that are being forced out of houses and into apartment buildings, or a lot of the unaffordable locations, people will get gobbled up into these lower units that have to be stuck at $600, $700, $800 a month. Investors may not love that idea, but when you can get that much more leverage on stuff, that's where you get a lot of investors that'll buy things up. They'll make it work. They'll put their cash into it because they'll see a long-term cash flow scenario, and that will create affordable housing on 10-year terms consistently. That'll take a long time for you to get those rents the way they have, which I think long-term will actually provide more affordable housing in Ontario, which is needed. So I do think that was the best move they've made.
So effectively what you're saying is you think there's a floor. There's a floor because people need a place to live. If they don't buy, they'll rent. And government is putting in place, CMHC and others are putting in place programs to incentivize people to provide rental housing. And, I've got kids that are, in that age bracket about thinking about buying a house. They're all renting and they're putting off house purchases today and staying in rental accommodation for all the reasons that you're mentioning, that it adds flexibility. You don't have to worry about the downside. You might be paying a little bit more than you would if you owned, but you didn't have to you didn't have to belly up to that huge down payment that didn't have money for. And I do think that a lot of people in the last couple of years, and you guys are the experts, not I, but I think a lot of people in the last couple of years went to second mortgages and private lenders, et cetera, to bridge that gap between what they could afford with a mortgage and the house price that they had to pay to buy the house they wanted. Serena, let me ask you a question. I understand that you specialize in the Avenue Road Lawrence area. What typically happens in a market decline is second homes decline the quickest and the most, luxury homes next, and basic family homes don't actually have that big of an impact because people need to live somewhere. What are you seeing? Is the luxury home, is the resort home, like you said, you were in Prince Edward County as well. Are the resort homes declining? Are the luxury homes declining at different rates than what the typical, middle income home is? Yeah,
it would seem so. So our brokerage is Avenue and Lawrence. I'm actually in Durham region. So when Dylan spoke about some of those price changes, I definitely saw that pretty significantly. But from our meetings and what I'm seeing with some of the realtors that specialize in Bedford Park, a lot of those luxury properties are still remaining at that height. I don't think they're necessarily as affected the way like a typical single family home that was selling at like 1.5, now it's selling at like 1.1. A lot of those luxury properties are still selling at like 3, 4, and 5 million. What I would say is the properties that are up in Muskoka have seen a bit of a decline. There was definitely the multiple offer situation where, you're seeing the 30, 40 offers on the cottage properties, but that seems to have kind of spun down very quickly with all the single family homes as well. And then on the flip side, condos were down during COVID and now they're trending back upwards with people moving back to the cities.
Serena, if people want to contact you either in Durham region or in the Avenue Road Lawrence area, how can they best do that?
Yeah, absolutely. So my email's info@serenahomesrealtor.com. And my cell phone is 647-896-6584. And I'm on social at Serena Homes Realtor.
And Durham and Lawrence and Avenue Road, or just primarily Durham?
Yeah, I mean, I'm from Durham. I've lived there for the last 30 years. So it's my preference to obviously remain in the area that's closer to home, but I definitely service clients in Toronto and even sometimes west of the city as well.
Excellent. And Dylan Suitor, if people want to contact you and access your incredible brilliance, how do they do that?
Very brave of Selena to give out her cell phone number there. I will give an office line, 905-592-4220. The easiest way to get in touch with me directly is to send me a message through Instagram at Dylan, DYLAN _Suitor, SUITOR, or you can email me at info@elevationrealty.ca, ELEVATION realty.ca.
Dylan Suitor and Serena Holmes, thank you so much for joining us tonight and telling us a little bit about your impressions about what's going on in the real estate market, what you think is going to happen, where things are going to go. We're going to take a break for a couple of minutes, and I'm going to come back and give you some of my concluding comments on what's going on in the real estate market. But bottom line, what the most wonderful things about our capitalist system is a market is based on people that have different points of view. And that's what makes a market. And it's wonderful to chat with Dylan and hear what he thinks in regards to the market and what Serena thinks about the market. And I guess my bottom line comment would be, before you buy or before you sell, because I think some people are thinking about selling before things go down even more, or they've got to sell, access a couple different points of view, whether it be from more than one real estate agent or a mortgage broker or a banker, and or some other people that might be knowledgeable in the market, because no one knows for sure. No one has a crystal ball, and so it's a big important decision, probably one of the biggest investment decisions that anyone's ever going to make in their lifetime. And one of the nice things is it's a tax-free investment if it's your principal residence. And so therefore it's one that everyone should exploit as long as they don't dramatically overpay. Anyway, we're going to be back in just 2 minutes with some concluding comments. Thank you very much for joining us, Dylan and Serena.